When we talk about the African startup ecosystem, it's a bit difficult not to mention funding, which has long been a major challenge for startups. Although reports indicate an increased interest from investors in Africa, recent data from Africa, the Big Deal, reveals a noteworthy setback. Because in 2023, there was a substantial 39% year-on-year decline in funding. So, what factors come to play when assessing the potential investment opportunities in startups? Oyin Sholebo, the managing director at ARM Labs, Lagos Techstars Accelerator, shares insightful perspectives on this. Tell me, Oyin, what are your thoughts on the venture capital landscape in Africa? I mean, what has changed in the past decade?
Sure. So venture capital, that is the funding of high growth startups, I think is a vital part of the development of our tech ecosystem, but it's been on a roller coaster ride over the past decade. So in the last 10 years, we've seen VC funding go from practically nothing to $4 billion in capital last year. We've also seen the emergence of the big four recipients of VC funding, so Nigeria, Kenya, South Africa, Egypt. And we saw the rise of the unicorn, that $1 billion valued company, mostly in Nigeria and mostly in fintech. We've seen more money come in from institutional VCs, but also from corporates, also from local investors and also from accelerators. But the last year or couple of years have been quite challenging for VC and for startups, not just in Africa, but for the entire world. So we've seen a couple of geopolitical crises. We've seen interest rates at record highs, which has meant that the cost of capital is higher. And there's just been a lot of uncertainty. So ultimately, what we've seen is the amount of capital going into Africa reduced by somewhere between 20 to 40% last year, depending on which report you read. And there's now this acceptance that with all of the money that was previously flowing in, valuations were overinflated. So we're now seeing a reset in the valuation of startups, how much they're valued, particularly for those growth stage, those startups that are further along. We've unfortunately seen a number of startups make layoffs, and we've also seen a few of them close. But going forward, I'm still really excited about the VC landscape and about the tech ecosystem at large. We are already seeing more institutional VC money coming in and also more corporate interest coming in. And I think there's been a shift towards a healthier view of startups where previously there was this idea that they should achieve rapid growth at all costs and focus on revenue rather than profits. But I think we're seeing more of a focus on business fundamentals, sustainability, businesses generating cash in a sustainable way and achieving profit rather than just revenue. So it's been a roller coaster ride. It's not been without its drama and challenges, but I'm still very positive about the landscape.
And from your experience working in the VC space and, of course, with startups, what factors do venture capitalists consider when evaluating potential investment opportunities in startups?
I think the two most important factors we look at are team and market, but we also consider the product itself and traction. So what do I mean by this? By team, venture capitalists will be looking at founder market fit. So are the founders uniquely positioned to succeed? Do they perhaps have specific domain or industry experience? Have they been a founder before so they understand the journey? Do they have some kind of unique insight into the customer? But also, do they have grit and an execution bias? Because it is not easy being a startup founder. The second thing I mentioned was market. So we're looking at, are these companies operating in a market that is big and that is growing and where the timing makes sense? We're also looking at the economics of that market. So is it a market where the company can make good margins, where there are good profitable prospects, and where the cost of them acquiring a customer is far lower than the revenue that they can generate from that customer? And then I mentioned traction. And if you'd asked me this question a few years ago, traction would have been less important for really early stage investors, but it's becoming increasingly important because of this funding winter that we've seen. So we're typically looking for startups that can show that customers actually value and are willing to pay for what is being built and looking for signs of accelerating demand and retention. So customers are coming back again and again to buy this product or service. And then it's the product itself. So are the founders building something that is better than the alternatives that exist in the market? So those are typically the four things that a VC is looking at.
But before these VCs make an investment decision, how do they assess the scalability and growth potential of a startup they are looking to invest in?
Yeah, so I think every VC will be different, but I think we will typically look at three key things. So the market size, the unit economics, and the use of technology. So when I'm saying market size, I mean that there will be some kind of calculation which estimates how much money that business can make. And some businesses look really attractive until you realize that they can't make enough money to make them what we call venture backable, perhaps because the price of that service or the product is too low, or perhaps because it's unrealistic to assume that they will get enough customers to really reach a large market size. And then we're looking at the unit economics. So by that, I mean, we're looking at the contribution margin. So how much money is left after each sale of a product or service after you've considered the variable costs associated with that? Yeah, so what is that margin? How much is that company keeping after the variable costs? And then also, how much does it cost to acquire a customer versus how much does it cost? What is the revenue that you can generate from that customer? So what is that ratio like? The more money you can generate from a customer at a lower acquisition cost, the better. And then the third element is the use of technology. So technology is an incredible tool, especially on the African continent, for achieving scale, because it allows companies to find more efficient ways to serve their customer, i.e. reduce their costs, and more ways of reaching their customer, i.e. making more money. So we're looking at how they're using technology to observe that, and also how complex is that technology? Is that company perhaps using technology in a way that they are creating a strong moat or this shield of defensibility that gives the company a lot of defensibility against its potential competitors?
Now, let's talk about exits. How do venture capitalists typically exit their investments, and what are the most common exit strategies they employ?
VCs will typically try to exit their investment, so basically try and get their money back from that investment in one of three ways. So IPOs, mergers and acquisitions, or a secondary sale. So an IPO, this is an initial public offering, which is when the company goes to a public exchange. So for example, Jumia did this some years ago, listing in New York, and more recently, VFD, the investment firm, did it via the Nigerian Stock Exchange. And in fact, the Nigerian Exchange Group is really trying to encourage more startups to list on their specialized technology board as a way of investors liquidating their investment. But it's still early days. The second way is mergers and acquisition. And this is the way that we typically hear about the most. So this is when one company buys another company. So for example, this is how investors in Paystack exited, because Paystack, the Nigerian fintech, was acquired by Stripe. And then the third way, which is less commonly spoken about, but actually happens, is through secondaries. So what that means is that one investor is buying that stake in the company or part of that stake in the company from another investor. And the reason this happens is because different investors have different risk return profiles. One investor might invest really early on and they want to get 7 to 10 times their capital back. And another investor might just be happy with 2 times their capital back. So in reality, IPOs is a route, but it's still very nascent in VC in Africa, as is, the VC and tech landscape at large. So when exits typically happen in Africa, they're mostly M&As, which are publicized, or they are secondaries, which are we're less likely to hear about it, but it does happen.
But recent reports show that there's been a decline in African startup funding. But like you mentioned earlier, Techstars remains one of the most active investors. So tell me, how does the mentorship and company building support you provide contribute to the overall development and success of startups that enroll in the accelerator program?
It's a great question, because I think to really support a startup to succeed, you have to, especially in this challenging market, provide them with more than capital. So Techstars, we provide them with this magic formula of capital plus a curated learning program plus community. And that community, that mentorship part that you've spoken about, happens in program, where we curate mentors specific to the companies that are in each cohort and introduce them to the startups, provide them with knowledge and expertise and guidance during the program, but also afterwards. But beyond that, the mentorship continues. So our founders are part of Techstars for life. So they get access to this global community of thousands of mentors, plus investors, plus other founders who are all there to provide them with advice and guidance and referrals to help them build sustainable businesses. And the data shows that it's working. So 74% of Techstars companies raise follow-on capital within 3 years, which is more than any other global accelerator. And 31% of Techstars companies exit within 8 years, again, which is more than any other global accelerator. So that mentorship-led model at Techstars is really key to helping those startups build sustainable businesses.
Well, thank you so much, Oyi Sholebo, for sharing your perspectives on tech trends. And of course, well done for the work you're doing with African startups.
Thank you so much. And thank you so much for the work you do in promoting all of the work that we're doing in the tech ecosystem.